My guest today is Mark Rossano, a global macro strategist turned business builder. He's the founder and CEO of C6 Capital Holdings, a firm that doesn't just invest in ideas, it builds companies that solve real-world infrastructure problems. Thanks a lot for coming to the podcast, Mark.
Oh, thanks for having me. And I love the way you pronounce my last name. You got it perfect. That's great. A lot of people, I don't know, it seems easy to me, but you nailed that one.
Thanks. But Mark, again, so what is your background and what's the origin story of C6 Capital and what problem were you trying to solve when you started it?
Sure. So I started my career at Morgan Stanley, investment management. I've always been on the buy side there. I built businesses and projects in 94 different countries under the Global Infrastructure Fund. There, it was about 1.4 billion. It was everything from petrochemicals, refining on down. And then it was actually FX and rates. So taking directional bets in FX and rates, both using forwards, futures, options, and interest rate swaps. And then we had a foot in both worlds, physical and paper. So I traded 33 different crude grades, LNG, the soft, so beans, wheat, corn, the underlying fertilizers, and then on the clean product side, gasoline, diesel. So loved it. Ended up in the Middle East, working in Masdar City, doing short cycle gas turbines, wind, solar, geothermal, and figuring out the right balance and mix. That then put me in Doha when they were expanding LNG, Riyadh when Saudi Aramco was looking to pivot further downstream and instead of just focusing on E&P, going into the refining petrochemical side. And then in Jordan, working with the U.S. military, getting gasoline and diesel into Afghanistan, doing geopolitical analysis in the Middle East, Eastern Europe, China, and helping NATO, funny enough, come off of Russian Urals or find a replacement for Russian Urals because that love-hate relationship would waffle back and forth quite often. Then I ran a portfolio at FMY Capital. There I was at a foot in both worlds, public-private. On the public side, I created what I call well-to-wheel. So this kind of gets to what you're asking, which was, I followed the hydrocarbon from the wellhead to the end user, and I created that across agriculture, across infrastructure, clean or sustainable solutions, because I noticed that everybody was siloed, nobody was talking to each other, so it just seemed like there was a huge opportunity set. On the private side, it was everything from a donkey head in Oklahoma, which is those slow-moving pumps to get up, a barrel of oil a day, to tech startups. So then went to go learn the high-yield distressed debt world. So followed the hydrocarbon lower after I made a call that OPEC was going to go into a price war. Did. So I followed oil prices down, and there I did high-yield distressed debt. So Chapter 7s, Chapter 11s, which are liquidations, bankruptcies, which came in as pre-packages, spin-offs to raise capital. So did a lot there. Decided it was time to start my own fund. Raised $5 million, was up about 38%. I found out my now middle daughter was going to need massive heart surgery at the 36-week sonogram. She was born on a Tuesday. That Thursday was the surgery. Surgery didn't go well. She ended up dying twice on the table. And then that Friday, they said she was in full organ failure and wasn't going to survive the weekend. So I ended up shutting down the fund because my two partners walked out on me. So she survived the weekend. She's 7. She's fine now, but she contracted MRSA, or a very bad staph infection, and needed a debridement. So I ended up living with her in the hospital for about 2.5 months. Needed a job, so I took a job as a commodity strategist at Bloomberg. And there, I think, where we started to see some opportunity, that's where I found my now partner, Fernando, who's fantastic. He does everything I can't do, or I can't do as well, especially when it comes to modeling and living in spreadsheets. And what we saw was when we decided to launch this in 2019, our view was that the world was just liquidity driven. The public markets were very frothy. Our view was that inflation, specifically in the U.S., was going to go well over 5%. We believed interest rates were going to go much higher. Our view is that the 10-year was going to be at 5%, and the Fed funds rate was going to have to chase it. So you were going to see a very different world. So we wanted to get back to what we do best, which was energy. And we saw a huge opportunity set in energy infrastructure. So there's a lot of, that's a broad term. So we really wanted to hone in on the two biggest pieces that we saw as the big drivers. One was baseload power. So we're buying up hydroelectric dams throughout the U.S., mostly the Northeast, the Midwest, and the Southeast, as well as on the agriculture side on providing real-world solutions on a fertilizer front to help farmers on not only just soil amendment, but also yield enhancement. Because since 2016, there hasn't been a global bumper crop. And one of the things that I saw back in 2010 was the shortages that were growing. And in the U.S., we call it Arab Spring. If you go abroad, it's called wheat wars. And we see something similar. So we really wanted to hone in on power and food security was the two pieces that we wanted to deploy capital and try to build long-term solutions.
Okay, that was a lot. I have few follow-up questions. Yeah, you mentioned the story about your daughter. You just said like it was nothing, but how was this period like? How did you overcome this? And
it's a great question. And so my sister has the second rarest disease in the world called fibrodysplasia ossificans progressiva, or FOP. It's when muscle and soft tissue turn to bone. So her body's trying to build a second skeleton within the first. So I actually wanted to be pre-med. I went into school. I graduated with an economics degree, but I went in wanted to be an orthopedic surgeon. So I'm a bit of a ghoul, like blood, guts, those things don't bother me. I learned, because I'm 4 years older than my sister, I learned to help compartmentalize where I can turn off the emotion and focus at the task at hand. And that was a big ability for me because I could kind of divorce myself from, I'm going to get her out of the hospital, so I'm going to do what has to be done, even if it's a difficult decision or it's going to cause her, near-term pain. But realistically, and the way I was able to do this was my wife. I've been with my wife since I had just turned 18. I'm currently 40, so I've known her longer than I haven't. We never fought ever in that almost 3-month period. We never fought. We were there for each other. And like even with the business, like she knew I was going to start this way before I did. And she used to say like, well, you don't play nice in the sandbox. And I was like, well, I think I play nice. She said, no, she's like, you need to be able to make decisions. And so she knows me better than I know myself. And she was the biggest driver, I think, on how we were able to manage that the way we did.
Okay. And the partnership when starting C6 Capital, how did it happen? How did you find Fernando?
So we started the same day at Bloomberg, and we just hit it off. He didn't understand why I was so happy, and my daughter had passed her swallow test, so it was like the best day in the world because now that was like the last issue. So he was looking at me. He's like, why is this guy so happy? He's like, it's just a job. So we hit it off. He actually sat behind me at Bloomberg. So the way they have is like 2 rows. And he was an energy guy. He did a lot on the refining E&P side. So we just bonded over our love of energy, our love of family and friends. He's a big soccer or football fan, not to offend anyone in Europe. So we just really hit it off. And then he saw me as someone who was really good at top-down analysis, global macroeconomic views. And I saw him as someone who could do bottom-up analysis better than anybody. And the benefit was we would kind of do the analysis from both sides. And 9 out of 10 times, we would come to the same conclusion. And typically, if you can come to the same conclusion looking at drivers where you're looking at, as the running joke goes, garbage in, garbage out with models, when it comes to your assumptions, I was really good at coming up with assumptions and sensitivities, and he was fantastic at incorporating them into where things currently sit and where they could be going. And we just saw the world in a very similar light. He's Brazilian by birth. He grew up in Rio, so he's no stranger to inflation and high interest rates. So when I was saying how I thought things were going to play out in the U.S., he's like, I know how to handle this. I think we could do something. And that was where it kind of grew from there. So we've been together now. I met him in 2017. and we've been together ever since.
So I'm a simple man. Again, English is not my first language as well. Some of the things you said previously of what have you been doing, like all the high yield stuff, chapter 11, chapter 7, very complex stuff for me, being brutally honest. So you started in 2019. So how was the first year? How was the second year? What did you do? And could you give an overview of the portfolio of what exactly are you doing and how does your day look like?
Sure. So in terms of Chapter 7, so Chapter 7 is liquidation. So if a company goes bankrupt and they can't pay their debt, they have to sell all their assets. And Chapter 11 is a restructure, which means that there's value in the company, but you have too much leverage. So you have to go in before a judge and get that restructured or changed into some debt. In terms of what it looked like in 2019, it was a lot of pain. There was a lot of just I hope we can do this. I had saved up enough money, and with the support of my wife, I was like, I think now is time. And so I had left Bloomberg, and we really focused on fundraising. And fundraising was difficult, just because we were a new fund, new managers. But people liked us because we had a unique idea. But the problem was we thought power prices were going to go up. And from 2000 to 2019 in the US, power prices were just flat. There was no increase in power. So when we were coming out to everybody saying power prices are going higher, people would look at us and be like, no, they're not. Like, power prices have been flat for the last 20 years. And we were like, no, things are changing. And the way we said things were changing was you had EV mandates, you had electrification mandates, you had data centers. I can't sit here and tell you I called AI. We did not, but we did see data centers and data becoming a big driver. And we really saw kind of the end of these efficiency gains. So if you think about efficiency gains, you had Energy Star or energy efficient appliances. You had LED bulbs. You had, in the States, we call them LEED buildings, which are just highly efficient buildings, double, triple pane glass, things to create efficiencies. But yet, even throughout all of this, everything stayed flat. And then the biggest driver was we were taking down base load power. We were shuttering coal, we were shuttering nuclear, and we were relying on intermittent, which is solar and wind. Now, I've worked closely with solar and wind since 2008, and I know the limitations of all of them. But yet, by 2014, everybody was ignoring the limitations of solar and wind. So we saw that with this big thing coming. And then the other piece was, nobody believed us when we said that the bond bull market was ending, and our view that the 2020s were going to be a stagflationary, inflationary decade, and you wanted to get into something that was going to be protected from these moves. And then on the fertilizer side, a lot of people were like, well, I don't understand. How is fertilizer energy infrastructure? And I'm like, well, 43% of all energy consumption goes into petrochemical and fertilizer. And everybody fought us until the power crisis in Europe in 2021, where the first thing to get shut down were ammonia plants. And everybody was like, oh, Mark, did you know fertilizer is energy intensive? It's like, yes, I did. So our day-to-day is really managing these companies. So we've taken active roles. We don't like to take full ownership. Typically, the way we like to think of it is we want to hear how management runs the company and then support them. And if we don't agree with their philosophy, we won't invest. Because typically you're going to be in the trenches with people. You want to help support them, and that's what we do. So we'll take different executive roles depending on the roles that need to be filled. So we do a lot of sourcing in terms of international, especially with Sultec, which is a global entity, just because fertilizer, especially on the shortages of sulfur around the world, and sourcing deals and helping fundraise, because fundraising is a full-time job in its own right.
So let's talk a little bit about the fundraising. Who were the investors you were talking to? Like, you put together a list, like who were the people you thought, like, there's a highest chance that we could raise capital from them? And how did it all go, and how long it took for you to close the initial round?
So we started with friends and family. Our view was that we wanted to go after more retail investors. It took us a long time. We didn't get to close the first round until 2022. And the reason why was 2019 was the startup. 2020 was this little thing known as COVID, which got in the way. And then 2021 saw an uncertainty in terms of where things were going. And 2022 was really where we saw people willing to deploy capital because they felt a bit more comfortable about where they were. It's been difficult all the way through, but then since that, so I had started a podcast, which is why I have this great microphone, such as yourself, and back in 2019, and because of that, I was able to show, look, we said this in 2019. Like now that it's happening in 2022, 2023, we called this. This was our view the whole time. And that got us a lot of credibility. So we were then pulled into more of the endowment space on the university side and large nonprofits and corporations. So now we've been kind of been pulled up in terms of check size, and that's gotten us into family offices. So far, family offices have been the more active. The problem with an endowment is you need an anchor, and so right now we don't have one, but the thing is, nobody wants to be first. Everybody wants to be second. And that has been the biggest hurdle that we've been trying to overcome.
How large is the team today, and what is the size of the fund? And when it comes to those portfolio companies, if I understand correctly, these are private businesses, but what is the size of these, and what is the a perfect scenario for you and perfect structure when it comes to investing?
Sure. So right now we are 12 million that's fully deployed. We're trying to get to 150 million. And in terms of the portfolio companies, we've done closes. So if you look at, we'll break it into the two key pieces, which is Artesian. Artesian is the power company. So there we're vertically integrated. So there we own the assets. We have our own operators, maintenance crews, and fabrication facilities. And the reason why is because a lot of times with hydro, cost is your biggest overhang when it comes to maintaining them. So we do what we call hub and spoke or density. We don't want our maintenance crews driving more than 2 hours. So one of the things that when I was at GE, we had access to soil samples going back 1,000 years. So you could see moisture gradients going all the way back, and there's never been a simultaneous drought in the Northeast, the Midwest, and the Southeast. So we wanted to diversify not only locations, but topography, geography, as well as pricing structures, because each area has their own key drivers. So what we've done is we now own 9 facilities in the Northeast. We're evaluating other areas. We have about 190 megawatts on the short list, 460 megawatts on a bit more of an extended list that we think we could go after. Ideally, we will have raised 150 million. We will have deployed it across. Let's say that realistically could buy us about 150 to 200 megawatts. We have access to, it's called the Rural Development Act under the USDA. So we have access to capital that is 30-year fixed rate. So, and it's at an advantaged interest rate. So there's a lot of opportunity sets when you look at where Artesian is. And just like everywhere else that is experiencing power issues, there's also limitations to companies that own power, but that's not their main business. So for us, that's our main business. So because of that, we have a lot of advantages by going into some of these locations and getting a better rate, better price. We're structuring PPAs with data centers. So realistically bringing the data centers on site because they've kind of realized that they can actually separate them into different areas, and it's cheaper to connect them by fiber optics than it is to have these mega data centers. So they want to decentralize. In terms of at the fund, it's me and Fernando. At Artesian, we have a team. We have our CEO, our advisor, Fernando, and I. We have several operators, which I think right now we're up to 4. On the maintenance crew, we have 3 full-time, 2 part-time. On the fabrication facility, it's 1 facility that has 7 people. On the Sultec side, it's the benefit with Sultec. It was an established company. They had a commercial demonstration plant. Globally speaking, sulfur is no longer falling for free out of the sky. That's happened since 2008 as we've taken sulfur out of, coal's no longer burning, steel's no longer, we've gotten much better at cleaning up sulfur. So you need to replace it, but you can't replace it with synthetics because a synthetic has an osmotic pressure, which just means it absorbs water. So as it absorbs water, you burn the root zone. So you need a solution. So we're the solution that's coming in. There we have the CEO. I stepped in as CFO. We have our commercial development officer, commercial marketing officer, and then we have the operators at the plant and our lead engineer, Andy. And right now we're building facilities in Canada and the US. We're evaluating Mexico as well as the Middle East, because the other benefit for us is the oil and gas industry is producing way more sulfur, and it's only going to increase over the next 5 years. So it's a waste product for the energy space. They just want to get rid of it. But for agriculture, farmers need it desperately. So our product is 70% cheaper than the alternative, and it increases yield up to 40%, but not only total yield, the quality of yield by up to 2 grades, or up to 40 to 50%. So the farmer, their return gets much higher. So it's just a matter of supporting them and helping them fundraise as well as build these facilities, given my experiences abroad.
And how did you find those deals, and how do you build the deal flow? And do you now actively looking for new ones, or you're just working on those you have on the portfolio?
Sure, great question. So on the power side, we're actively buying there. That's where our big focus is at the moment. So if I was to get $100 million tomorrow, 95 million of it is going into hydro, just because there's such a great opportunity on the power side. Sourcing those deals are 4 key ways. One is word of mouth. Typically a lot of these dams are together or on the same river system. So if you buy one, you'll get a phone call the next day. You'd be like, hey, are you interested in dams? Do you want to come see mine? That's one. The second is through brokers. Brokers are actively out there looking to sell some of these, because some of these assets were purchased in the 60s, 70s, and 80s, and the owners who took care of them want to exit. They want to move to Florida. They want to retire. But they didn't invest new capital. So there's a huge opportunity where we can actually increase the efficiency 15 to 20% with very little invested capital. The other is non-core. So the issue now is like a lot of paper and pulp mills, a lot of textile mills, they no longer have the ability to carry these assets, and they're looking to divest. There's some entities that want to get bigger into something else, and they're looking to sell. So that's the third, which is where we are now in terms of getting some of the bigger packages. And then the fourth is, so there's 90,000 flood dams in the U.S. that you can add a powerhouse to, which is where the turbines would sit. So there's a huge opportunity, especially in the Southeast, to work with the Army Corps of Engineers and FERC to add those those powerhouses. So that's the kind of the fourth way, where it's not really a new build because the dam is there. It's just we would have to build the powerhouse itself, which is something that we would be excited about.
And when it comes to structure of those deals, you mentioned you own minority, right?
So in the Artesian one, we own 50% of. That's one that we put up half the capital. As we get bigger, our partner will likely come under our umbrella, just because he's a fantastic operator. He knows these intimately, and we want to make sure that he's taken care of, because we think there's a huge opportunity there. So that's something that we created it with. The partner's name is Justin. We created it with Justin. And the way that we came about this was we actually wanted to buy propane suppliers, because we thought power was going to be a big opportunity. Natural gas is kind of difficult. Fuel oil is expensive. And when we realized the politics behind propane, we decided to pivot. And that was when we got into these hydroelectric assets, because it was a natural way to be sustainable, but yet in a baseload capacity, much better than solar and wind, especially in those areas. And so there's a lot of expansion there. On the Sultech side, that's something that we do have a minority. We own 28% of the company. And it's really because we wanted to be supportive. One of the things that we've always been looked at is, how does the person run their company? Like, what do they think should be done? And you want to make sure everybody's incentivized. My old boss back in Morgan Stanley, he looked at me after I had built a trading system, a new trading system for the team, and he's like, look, you need to appreciate something. He's like, you can either own 100% of a million or 10% of a billion, and 10% of a billion is way more fun. And he was essentially saying that you want to share. If you share in the wealth, if you share in the growth, you're not going to own a million. You're going to own 100. You're going to be worth 100 million. And it'll only be 10%, but it'll be 100 million with more running room. And I really took that to heart, because I think that there's a lot of things, like the running joke with Fernando and I is we created a private equity firm because we hate private equity. And to your point at the very beginning, we want to build businesses. We want to invest in businesses and expand them and create solutions where over the last 20 years, what did a private equity firm do? They bought it. They fired half the people and they moved it to China or somewhere else, and the quality of the product diminished. We don't want that. We want the quality of the product to get better. We want it to grow. We want to hire people. We want to expand. And don't get me wrong, we plan on making money, but also answering or providing a solution to these, I think, real world problems.
But the holding period, it's typical like 5 to 7?
Yeah, so we're typically 7 to 8, which is actually pretty short for a infrastructure fund. Typically, an infrastructure fund is a minimum of 10 years, and the reason why is because there's construction risk, and we didn't want to take construction risk. So when you look at Artesian, which is the hydro, these facilities have been in existence since our oldest dam was initially built in 1865. Our youngest dam was built in 1937. So these are assets that are there. They're already connected to the grid with the wire line overhead. And then Sultech is a very quick deployment. So we can build a 100,000-ton facility in 6 to 9 months in North America, in 10 to 12 months abroad. So you're not taking where typically if you're investing in an infrastructure fund that's going to build a natural gas facility from the ground up or a petrochemical facility from the ground up, you're looking at something measured in 18 months to 5 years. And we just didn't want to take that risk because we think that there was a big roll-up opportunity where we could consolidate a lot of these power assets and create a lot of efficiencies by just smaller investments, streamlining operations, and increasing throughput.
What has been the reason for Artesia and Sultech why they decided to sell those shares to you? And so my question is why they decided to partner with you. So what do you bring to the table, and what was maybe the pitch to those companies when you meet them before it all started?
Sure. So the Sultech was, so you had asked earlier, which I touched on, but I didn't answer completely. So Sultech was introduced to me by a friend of mine on Twitter, the Twitter sphere. And he's like, look, you have a background in energy and ag. You should look at this. And because when I was in the Middle East and I was working at Masdar City, my job was to take science math and turn it into finance math. So I spent my career speaking to engineers, speaking to developers, speaking to inventors. So for me, I can speak very well with founders and engineers, because a lot of times the founders will be from an engineering background or some sort of hands-on approach, and that's the biggest hurdle, is taking them and making them realize that you have to be able to market and sell this product, because sometimes the creators almost want to hug their baby to death because they think it's worth too much. and that becomes a big issue. So when you talk to people, and this is when we spoke to Soltech, they appreciated the fact that I understood ag, because a lot of people, especially in the finance world, don't understand agriculture, don't understand fertilizer, don't understand the intricacies that come with these assets. So my pitch to them was, not only do I understand what's happening, but I also think this is a global opportunity. And because I had experience working with the U.S. government, working with international entities, that became a big opportunity set. The other, on Artesian, we met Justin. We went to go tour some facilities together, and we saw that we had a very similar philosophy to don't cut corners. You don't have to buy the Cadillac or the Ferrari piece, but you can buy the Toyota piece. And we had a very similar mindset of creating a repeatable process, and it just became a great opportunity set. He had trouble finding banking opportunities to get capital. That's our background. So we were able to kind of bring both of these skills together. And when we look at future investments, as we always are evaluating the next investment, it's, do we fit with the people on the ground? Especially on the hydro side, who's the operator? Are they? A lot of people there are very passionate about power, about their hydroelectric asset, and we want to embody that and really say, it's like, look, we're going to take care of this, and not only are we going to take care of it, we're going to invest money in this because we believe in it. And they get really excited about that. And we ask people, what do you want to do? And a lot of times it's like, hey, like, I'm a master electrician. I like doing rewiring. So it's like, hey, you're not going to be just at this one site. You're going to be throughout our whole portfolio in this region, and you're going to do what you love everywhere, because they love playing with power, playing with electricity. And those are things that we really like to enable, so that people feel motivated to work there.
So you closed the fundraising in 2022. So you're 3 years in. What's something you've learned from running real businesses that you could never understand just from reading reports or data?
It's funny that you say that, because the reason why we have opportunities is because a lot of times people become, Excel warriors, and they don't go in front of the balance sheet or in front of the model, because realistically, a model is a snapshot in time, and it's a snapshot. And don't get me wrong, you need a model, you need to understand what you're getting into, but how do you improve? And it comes down to understanding the sensitivities and the how long it's going to be. And there's a famous entrepreneurship quote which I love, which is, slower than you expect, faster than you ever imagined. And I think that because it's like, why isn't this taking off? Why is this so slow? Why are we not gaining traction? And then the moment you gain traction, it's a hockey stick. All of a sudden you went from, oh my God, we're not growing. Why aren't we growing? And to, oh my God, we're growing so fast. How do we keep up? And I think that is the biggest shock that I've seen, is that you pour your heart into something, and then waiting for it to take off, and then it finally explodes, and that's explodes in a good way here, because exploding in infrastructure is usually a bad thing. But for us, like, this was a very exciting piece. So we are still actively fundraising. So the first close was in 2022. And we typically have a close until we get to that large check. Once Soltech, so they're currently raising funds now. Once that happens, it'll be at a much higher valuation. So we will close that fund. And then we are going to launch another fund, which is just going to be purely hydro. And then we're going to have another fund that's going to be purely agriculture, just because we think that there's more understanding within that. The other piece that I think you don't understand or appreciate till you're in the field is dealing with the downstream. So one of the things that we've always prided ourselves on is being very good at looking at the total addressable market. Like, how big is that market? And one of the things when we invest in something is we don't want to sit here and change the consumer. Because like, if I am trying to convince you to say, you know what, you shouldn't drink water, you should drink something else. I have to invest in marketing. I have to invest in free product to you to get you to say, don't drink this water, add this powder. Changing people's mindset is very difficult. So what we want to look at are solutions that fit into today's infrastructure. Like with Sultec, the product goes through all of the farmer's equipment. So the farmer, no capex. The farmer can change. It doesn't have to change when they put down product. They can put down sulfur at any time because of the way it is. Because if you have to come in and tell the farmer, it's like, oh, by the way, you have to buy all new equipment, and you can't put down sulfur. When you put down sulfur, you have to change when you do that. And it's just, that's a high hurdle. So those are things that we wanted to avoid, and we've been very good at avoiding. And because we want things that just slip into people's normal everyday life instead of trying to invest to convince them otherwise.
So trying to understand a bit of your thought process and turning this theory into action. My whole life, my experience, my strength is sales and marketing, soft skills, communication, all this part. You have this deep background in macro, which is your strength, your massive benefit. So my question is, how do you actually use those insights when making decisions day to day?
It's funny because now what's happening in the market is, I think, a good indication. So my background being in also rates, currencies, we wanted to create something that was insulated because our view was that inflation was going to go higher on a macro basis. We saw global liquidity increasing. We saw global debt increasing. So we wanted to protect ourselves and get into things that are going to be insulated from a recession or insulated from trade wars or geopolitical risk. So if you think about Maslow's hierarchy, which kind of dictates the level of human progression or human thinking, the most basic piece of the pyramid is food, water, and safety. So safety, in our view, is power. Today's world, safety is power. So food, water, and safety. So how do we invest in those things? And if you look at just on a global basis, you've had gates go up, restricting exports of food. India banned the export of broken rice. Vietnam put restrictions on how much rice could be exported. You're seeing these continuous issues because food security is a huge problem. When you look at power, power availability is a very big problem. And we wanted to focus on things that were going to do very well or, at least not get pressured against what is going to happen. So we were looking at the broader picture of food is becoming a much bigger problem. The quality of food is becoming a much bigger problem. How do we address that? What is the most basic way we can address that? Then when you look into the power side, power in the US is tied to inflation because a utility company is guaranteed a rate of return. So if we buy an asset, we know that if inflation goes up, the power prices go up. If we own a physical asset, the asset's value goes up. But as somebody, and Fernando included, who saw rates going higher, don't use leverage. Be very careful when you use leverage because a lot of times private equity firms buy a cash flowing asset and turn around and put 100% leverage on it. It's like, guys, you can't do that. These are commodities. These are things that if you are wrong, you will blow up. And so one of the things that we wanted to look at is being very cautious on leverage and finding things that were going to be protected because, there's a lot of opportunity sets on a global basis, but also on a local basis. So on Sultec, for an example, we're building facilities in multiple locations. So that enables us to get around any types of trade restrictions. But fertilizer is short, especially with the Ukraine-Russia war. There's an opportunity set to change people's, what they use and providing a cheaper product.
Now, when it comes to capital allocation and your thoughts on this, how do you decide where to invest your time, capital, or energy, and what makes you say no? As now you're in the game, you have, you said you're constantly working on fundraising, so
So what makes us say no is a great one, because a lot of times you want to hear, what is your, to the founders or to the creators, it's like, what's your exit strategy? How do you think you exit this? Is it an IPO because you want this company to be huge? Is it a sale to a bigger entity? And a lot of times you hear people and they say, oh, we're just going to sell to Amazon, or, oh, we're just going to sell to Google. It's like, no, you're not, because there are 1,000 other companies that think they can sell to Google, to Amazon, to the behemoths. What value are you bringing to them that they're going to care? And I think that's the biggest component when it looks at what is the exit point, and then what do they understand their total addressable market to be? Because a lot of times everybody's like, oh, everybody's going to buy our product. It's like, all right, well, why? Because one of the things in commodities specifically, you want to be the lowest cost producer. You want to be the last guy turning off and the first guy turning on. And if you're not the cheapest, somebody's going to be cheaper and you're going to go out of business. The other side is because we deal a lot in sustainable and renewable investments. A big focus is, it's like, oh, well, we have subsidies. It's like, okay, well, what happens if the subsidies go away? Oh, but they won't. It's like, so you're going to take what we call signature risk, which is there is a president, a prime minister that could come in, sign their name, and your subsidies are gone. So the moment we look at or start to evaluate a company, we take all government subsidies to zero, because to us, true sustainability is cash flow, is where's your free cash flow, because that's how you're going to be sustainable. And don't get me wrong, if a government wants to give me a free dollar, I'm going to take that dollar. But the way we describe it is, all government subsidies should pad the returns, not drive the returns. And a lot of times we speak with companies and they're like, oh, well, look at all the money we're making on these payments. It's like, all right, well, what happens if 5 of them go away? Oh, well, then we're bankrupt. It's like, okay, well, why do I want to invest in this? And one of the things, back to your early question into this one, a lot of people didn't appreciate where prices or where interest rates were going. So one of the things that we saw was a lot of companies required 2% debt, or ZIRP, zero interest rate policy, where everybody was like, oh, well, money's free, so what does it matter? It's like, no, that's not the right answer, because interest rates are going up. So if you need 2% interest rates to survive, you're bankrupt. So one of the things that we look at is, how does their business survive in a higher interest rate world? And that shook out a lot of people. And right now, like, a lot of the competition we used to have for buying hydros has gone away, because they went into solar and wind. They had tax equity, but all of a sudden their 2% carry became 5%. Their 5% carry became 9%. All of a sudden, they now have these issues. And then to your point on the macroeconomic, my expertise was also in supply chain. So also, where is your supply chain? How secure is it? Where are you getting your source equipment? Where are you getting your growth equipment? Is there going to be an issue in terms of building? Because, I mean, just ask car companies. During COVID, they could get engines, they could get everything else. They couldn't get wire harnesses. Wire harnesses are these little plastic things, and so they had to turn off full supply chain, facilities, full factories, because they couldn't get wire harnesses. These are things where if you don't have one bolt, the whole facility shuts down. And that's where we like to look at things on a holistic basis, to not only understand how the business is operated, how are you financing it, and then where are you selling it?
You mentioned before that you don't want to do anything when it comes to changing the customer's behavior, where you need to educate them because it requires sales and marketing. What is your thought about that when it comes to some of the examples and maybe some of the mistakes that maybe some of your competitors are doing, or maybe you've seen other entrepreneurs are doing? They're doing it because they don't get it, what you just said. So maybe some examples.
Sure. So when we were in 2015, we were investing. We were looking at midstream. So midstream is getting the hydrocarbon, whether it's oil, natural gas, into something else, into the refiner, the midstream side. So one of the things, that was when OPEC went into a price war, and you saw oil prices dropping. So a lot of the midstream contracts were structured under what's called POP, which is percentage of proceeds. So it means that they got paid a percentage of whatever they sold the propane for, the ethane for. So one of the things that we saw was that naphtha, which is condensate, was getting much cheaper. So the petrochemical companies, Dow, DuPont, Syngenta, they're going to buy the cheapest product that gets them further down the value chain. So one of the things that we saw was these companies were assuming, I can sell this propane. It's like, well, propane prices are going to go down because Dow is going to buy naphtha. So your propane is going to be worthless unless you're willing to take prices much lower. And if you do, your value is going to be underwater. And they're like, no, you don't understand. I was like, all right, well, tolling is really what you need. You need to restructure these contracts. So they didn't listen, and they didn't appreciate the end market. And all of a sudden, a lot of these investments ended up going belly up, and they ended up going away. And I think it was what didn't they understand? They didn't understand their end market. They didn't understand what was going to happen, and they took too much leverage, so they didn't have time to let their thesis play out. So I think realistically, the things that we've seen the most of is an inconsistency with how to structure a deal, where people were relying too much on cheap money and not appreciating where their product is going and how that product was going to get into their end market and what their competition was. Because I think the competition side, or how their customer was going to purchase, there was a lack of understanding. So one of the things, especially when you look at agriculture, you have to appreciate farmers are very intelligent individuals that are running a very complex company, and they're going to listen to the experts. So there are some people that just come out and say, oh, I'm going to go talk to the farmer. It's like, well, you have to go to talk to the university first, because the university and their studies is going to influence how the local farmers view your product. Then you have to make sure your product is available, because if you overpromise and underdeliver to a farmer, you're never going to sell to them again, because you just impacted their livelihood. And I think that a lot of times there's a lack of understanding or a lack of willingness to understand the end user. And I think that's where you see the most error, is understanding the end user. Look beyond meat. I'm going to convince people to eat crickets. It's like, no, you're not. Like that's a big leap. And I think there's that problem in terms of understanding the market. The next is leverage, and how did they structure the deal? And then the last one is trying to find a unicorn. A lot of times, especially in the sustainable, renewable world, everybody wants the shiny thing. They're like, oh, well, that's going to revolutionize. It's like, well, if you can take smaller steps and still essentially create change, well, why do I have to go from 0 to 100? Why can't I go from 0 to 30 and then use that 30 to get to 60, then to 90, and then to 100? And I think a lot of times there's a lack of understanding of how the adoption is going to be and how people are going to be able to consume that product.
You mentioned fundraising, that you're constantly doing this. Do you raise it on the HoldCo level or on a fund level, or you raise it for a specific company? Because you mentioned, what I'm trying to understand is your main focus when it comes to your portfolio companies. Previously, you mentioned if you would raise 100 million, you would do X, Y, and Z right away. So what is the thought process there, and how does it match with the fundraising?
Sure. So it's the opportunity set, because every sector is going to compete for capital. Where am I going to get my best return? And right now, the best return is in the hydroelectric space because there's the buyers have gone away for the most part, or there's not as much competition, so prices have come down. The demand for power is going up, and there's a huge opportunity set in there. So there we take it into the fund, and then we then allocate those funds down to the HoldCo, or I should say the PortCo, and then that's where we see the opportunity set. So on the Soltech side, we're invested in that, and they're currently doing an A round. We are also investing in the A round, but we also want other individuals to come in just because we can't invest in the full amount. One of the things that I learned long ago is a 10% restriction. You never want a single company to be more than 10% of your portfolio. It's a risk management tool. It's just a way to protect yourself. So there, we will be diluted a bit, but we're comfortable with that because we think that we could bring in a strategic partner, which would help everybody, not just ourselves, but the whole company continue to grow. So for us, it really comes down to where is our best return and opportunity set, which is for us in power, and then where can the growth be? So right now, we want to bring it into the fund and then deploy down into the portfolio companies.
A bit of off-topic personal questions, trying to get a bit of like timeless advice from you. Like, what idea, framework, or mental model do you come back to most often when things get hard?
So, it can always be worse. Is always, I would dealing with my sister, which is she has an illness that is progressive. So it's only gotten worse. She went from running and jumping and playing basketball to being stuck in a wheelchair. Dealing with the potential death of a child. Luckily, it didn't result in that. But for anybody that's dealt with that, you wouldn't wish it on your worst enemy. And it's just there's going to be light at the end of the tunnel as long as you look for the light. And things get dark. I mean, to sit here and say that I didn't come into the office and cry or stop along the way and think, why am I actually doing this? Like, this is insane. But again, if it was easy, everybody would do it. So it's a matter of, why are you doing this? Why are you driving forward? And can you weather the storm? And as long, and the running joke is, if when God closes a door, he opens a window. And it's true. But you have to be able to find that. And one of the things growing, being in the industry as long as I have, you'll get turned down for a job, or you won't get something, and you get so depressed. And you're like, oh man, why did that happen? Like, I really wanted that. But the one thing I learned is, don't be myopic, because 3 years from that point, you're going to look and you're going to be like, oh my God, I didn't get that job because if I didn't go this way, I wouldn't have the skill set I have today. And if I didn't have that skill set, then I wouldn't be able to do this, or I would have missed this opportunity. So I think it's putting everything in perspective and recognize that you're on a path. Know where you want to end up, but don't think you're going to take the straight line. It's likely going to be a lot of zigzagging in between, but the lessons you learn along the way are going to help you excel when you finally get to what your goal is or what your achievement is. I entered school to be an orthopedic surgeon. I left school thinking I was going to get a PhD in economics. And I ended up in the commodity world doing something similar, but still quite different. And it's because I found a lot of these different avenues. And I think, going through what we've gone through, it's created empathy. I understand where people are coming from, which I think makes it better to work with me, because I understand I can put myself in someone else's shoes. I've seen the darkness at times. And it's just, also the one thing that I think I learned being in this seat more than anything, you end up becoming somebody, founders and portfolio companies, you end up becoming their therapist. They're going to call you and say, "Oh man, it's so hard." And you become a motivator, you become a cheerleader, be like, "No, I invested in you for a reason. Like, I'm with you right now and I'm not leaving because I believe in what we're doing." And you almost become you're a cheerleader, and in yourself, you're getting self-doubt. It's like, "Oh my God, should I have not done this investment?" It's like, "No, I did this for a reason. We're going to see it through." So that's, I think, some of the big pieces behind it.
But so a question to you: why are you doing this? You have such a hardship in your family. Then you go and start raising a capital for a fund, which is very hard, and you do it while like COVID is spreading around the world, and it takes you 3 years. Like I've been doing this. Most people will give up. I've seen that many times. It doesn't matter how smart they are, how experienced they are, how great of a network they have. It's very hard for everyone. So, and you go and do this. So, why are you doing this?
So, I believe in our investments and what we're trying to achieve. I like to say it's stupidity or a chip on my shoulder, because I was thrown out of a lot of offices when I went to the bigger guys to say, "Hey, this is what I think is happening," and they're like, "You have no idea what you're talking about. You don't understand power and rates." And I was like, "Well, I'm going to go do it myself then." And a lot of the people that I've spoken to throughout my career, they started their businesses in terrible times, in crashes. And not to talk about Forrest Gump, but if you look at Forrest Gump, when he's on the shrimp boat in the storm, and they weather the storm, and then they go back to the harbor, and all the other shrimp boats are broken and decimated, and all of a sudden they're the only one standing. So I think that we have a great idea. I think it's a unique idea in terms of how we're creating solutions. And to your point, I think a lot of people would have given up. But every time I've thought about giving up, my wife is like, "No, we're doing this for a reason. I believe in you. We're going to get through this." And then anytime we think about it, all of a sudden a new investor appears or a new opportunity appears, and it keeps kind of driving us forward. So I think we're on the right path. It's been much slower than we would have liked, given everything, but that's what kind of keeps us motivated and moving forward.
One last thing I wanna get from you, a lesson you shared in the beginning of the episode, which I didn't have the follow-up question then, but you mentioned something like turning your emotions off. Could you explain? Because I think it's extremely important when one thing is when the hardship in private life, but in business as well, when things are going south. So you sometimes need to turn off yourself, your emotions, and just keep doing what you promised yourself you're going to do. So how does it work?
So one of the things that I learned, you always want to survive to fight another day. And sometimes you have to make very difficult decisions that are going to be near-term painful, but long-term beneficial. And as somebody who is trading and investing, at a time, billions of dollars, you have to know when to walk away and when to protect yourself. And I think that's the biggest hardship when you look at trying to invest. It's when do you accept you're wrong? And one of the things that I learned, my old boss used to say, he's like, two things. One, the bus that hurts the most is the one that you don't see coming. So if I'm bullish something, and it's like, say for an example, I'm bullish Microsoft, you're bearish Microsoft, I want to sit down and just listen to you talk. Why are you bearish? What do you see that I don't see? And I'm not going to fight with you. I'm just going to ask questions similar to what you're doing. Is like, well, because you might say something like, "Oh, wow, that's a great point. I didn't think of that. Oh, and then all of a sudden you change your sizing, you change your viewpoint. And I think a lot of times people get into their own silos and their own, echo chamber. And it's good to break out of that and find someone else's views. But just from a personal perspective, it's difficult. One of the things that I learned with my mother teases me and tells me that I have ice in my veins because I'm very good at being clinical, because sometimes you have to recognize that your emotions are going to get in the way, and that you're going to have to do things by the book and take that emotion away, because it's going to be difficult. And I learned that with my sister. I learned that again with my daughter, to the point where I was changing her dressings in the hospital, and the nurses were surprised that I was able to do these things. And it's just because it's like, no, I made a promise to her. I was going to take her home, and I'm going to keep that promise, no matter how painful it may be. I'm carrying her out that door with me. And I take that into the world of investing. It's like, sometimes you have to know when to cut and run. And I think that's the hardest lesson to learn when you first enter the industry. It's, when do you admit you're wrong? When do you accept the loss? Because a lot of times a trade becomes an investment the moment the prices go down. Like right now, people might be sitting there and be like, if I just wait a little bit longer, it's like, no, it's a piece of fruit. So if the market wants apples and you have oranges on your fruit stand, it's going to rot and you're going to go bankrupt. So what you need to do is make sure, if the market wants apples, you own apples. If the market wants oranges, you sell your apples and you buy oranges. And it's okay to sell and buy back in. One of the things that I always got in trouble with was I was always early. The running joke was, if Mark buys something, wait 6 weeks and that'll be the time to enter. And in private equity, you get paid to be early. And that was another thing that I really liked about it, because we were early on power prices. Nobody believed us. We were early on the need for different types of fertilizers. But that creates an opportunity set on the long term, because you get in early, which means you're selling to everyone else the moment they realize something is going on. So it kind of works in both ways.
Okay, Mark, thanks a lot for sharing all this. This is the reason I'm doing this podcast. I sometimes say this. I want to see behind this fund, who is this person who's making those decisions. And today I 100% understand like what's going on, what you're doing, and how you're thinking, and probably most importantly, what have you been going through in order to do what you're doing today. So 2 quick fire questions. Number 1, what is the best investment advice you've ever received? And number 2, what is your favorite book?
Okay, so the best investment advice I've ever received was, I think it's the one where you can own 100% of a million or 10% of a billion. I think that was the best investment advice, because especially when you get into corporations or private investments, that you need to give up some control, and you need to find people that are better than you. Because one of the things that I find in the industry is everybody gets very protective of it's like, no, it's like, share information. Like if you and I are working together, I want to empower you to make decisions. And I think that is the biggest thing, is really share responsibility, bring people along with you for the ride. And then what was the last one?
Favorite book?
Oh man, I'm a big reader. So I would say my favorite book of all time would either be The Alchemist or Viktor Frankl's A Man's Search for Meaning. Because I think it was a very interesting breakdown into the psychology of how people go through emotions and come through a survival mode. And I would say that those were 2 books that kind of shaped how I viewed the world.
Do you just read it once and then you got the lessons, you got the frameworks, or you just go back and read it again and again?
Funny that you mentioned that. So I probably read The Alchemist when I'm struggling mentally, or otherwise once probably every 2 years. And A Man's Search for Meaning, I've probably read 6 or 7 times at this point. I actually read when my daughter was in the hospital. They had to put her into a chemically induced coma, medical coma, and I read it to her. And those, I think those were key things, because that was when, because you're going through your own issues, your own mourning, and I think that was the last time I had read it.
Okay, so As I said, thanks a lot for doing this, Mark. I really enjoyed this conversation.
Oh, it was a pleasure. Thanks for having me. It was I think that your questions were fantastic. So I appreciate you digging behind the scenes, which I don't think a lot of people do.